Welcome to PIMCO Pod. In this episode, we discuss whether AI could lower, not raise, neutral interest rates over time and what that means for monetary policy, bond markets, and the economic outlook. Stay tuned after the conclusion of the podcast for additional important information. Does AI raise or lower neutral rates? By Tiffany Wilding and J.R. Scott. A growing share of central bankers argue that artificial intelligence will ultimately push neutral interest rates higher. Intuitively, if AI boosts productivity and lifts long-run growth, then households have less incentive to save, pushing up the real neutral rate. This view has become increasingly embedded in policy discussions, with some observers pointing to the late 1990s when higher productivity growth coincided with rising estimates of the neutral rate. This is a crucial discussion for monetary policy, as the real neutral rate, though theoretical and unobservable, often serves as a guidepost. It's the rate that neither stifles nor stimulates economic growth. Economists call it R*. However, existing empirical evidence offers little support for the popular narrative around AI. Rather than rising, long-dated real and nominal yields have tended to fall around major AI-related news. Looking specifically at market reactions to large AI model releases since 2023, the cumulative change in forward rates suggests that investors are revising neutral rate expectations down, not up. Even if one is skeptical of event-based analysis, it is notable that there is no consistent evidence that rates have risen in response to AI developments. The neutral rate and the five-year forward. As mentioned above, the real neutral rate is a focus for central bankers because it sets a useful marker as to whether the policy rate is restricting the economy or accelerating it. A widely used definition of R* is the real short-term interest rate that would prevail when the economy is at full employment and inflation is stable. By definition, it's a long-run concept, and it abstracts from temporary shocks when the central bank might need to adjust its actual policy above or below neutral. Because R* tends to evolve along with slow-moving structural economic forces, including demographics, productivity, and savings/investment trends, central banks must understand not only cyclical economic dynamics, but also how R* evolves to effectively set policy. The issue is that because R* is unobservable, it must be estimated, and its estimates are subject to a lot of uncertainty. One way to proxy, rather than estimate R*, is to use market-implied rates. Specifically, the five-year forward rate, 5Y5Y, is a useful proxy because it's the market-implied rate expected to prevail once short-term cyclical effects have faded. The five-year forward embeds investor expectations of the average overnight rate in the far future, plus a term premium, compensation for the risk of locking in a fixed payment in the future, as opposed to investing in a short-dated bond and continuously rolling at maturity. Event studies looking at changes in five-year forward real and nominal rates offer a useful benchmark for how the market responds to releases of new AI models. Since expectations for these models tend to be priced in advance, the market reaction on the release date reflects how well the new model exceeded or fell short of those expectations. AI, a source of productivity and uncertainty. Event studies that measure changes in forward rates around significant model releases suggest that, rather than rising, as would be consistent with market expectations of AI contributing to higher R*, long-dated real and nominal yields have tended to fall around major AI-related news. Figure 1 plots the cumulative change in the five-year forward real interest rate since January 2023, separately tracking how the forward rate responded on the 43 days that marked significant new model releases from OpenAI, Google, Anthropic, xAI, and DeepSeek. Even though the cumulative change in yields over this period was roughly 100 basis points, BPS higher, the cumulative yield change on model release days was roughly 100 basis points lower. In other words, if we exclude the AI release days from the sample, cumulative yields would have risen 200 basis points over the period. Researchers from MIT recently presented a more exhaustive study with similar results. This raises an important question. Why might AI lower, rather than raise, neutral interest rates? One possible explanation is that AI is not purely a productivity boost, but also a source of economic disruption. While the long-run effects may be growth-enhancing, the transition itself introduces uncertainty around labor income and job stability. Households facing greater risk of displacement may increase precautionary savings, boosting demand for perceived safe assets and putting downward pressure on neutral rates. In this sense, AI may operate more like a risk shock, even if it ultimately raises potential growth. This mechanism distinguishes the current episode from the late 1990s technology cycle. The earlier wave of innovation was broadly labor-augmenting and associated with widespread income gains. By contrast, current equity valuations suggest that the potential gains from AI will tend to be more narrowly distributed and disproportionately captured by a subset of capital holders. The resulting concentration of income gains and the uncertainty surrounding the transition may amplify precautionary behavior rather than reduce it. Research has also linked a declining R-star to the decades-long decline in labor share of income. There is also a second potential channel operating through fiscal expectations. Stronger productivity growth raises the long-run tax base and improves projected fiscal sustainability, all else equal. To the extent that markets capitalize higher expected future surpluses, this can compress term premia and support lower long-term yields. While this framework abstracts from the possibility of offsetting increases in transfer spending, it suggests that AI-related news can cushion government bond valuations on the margin. Researchers from the London Business School and Stanford recently explored this logic, arguing that because U.S. tax revenues are highly sensitive to long-run productivity growth and spending is much less sensitive, U.S. bondholders effectively have a long position in AI with option-like payoffs. Using a Federal Reserve Board staff model to estimate term premia and rate expectations, we find that declining term premia explain around half of the overall decline in long-term yields around AI model releases. Bottom line. AI is widely expected to push neutral rates higher, but we're seeing market-based evidence that points in the opposite direction. While market reactions could shift over time, these dynamics at a minimum complicate the current policy narrative. Even if AI ultimately raises trend growth, its near to medium-term impact may be to increase the demand for safe assets, compress term premia, and lower real neutral rates. In other words, AI may be bond bullish over the medium term, lowering neutral rates via precautionary savings and improved fiscal expectations, even as it raises longer-run growth potential. Thank you for listening. That was Does AI Raise or Lower Neutral Rates? For future insights, please follow us on your favorite podcast platform. Macro Signposts highlights weekly takeaways from the data analysis conducted by our team of economists and other macro experts. For PIMCO's official views on the global economy, please visit PIMCO.com. This episode uses an AI-generated voice. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.